It is February 4th, 2026, and I want you to picture two people. They're sitting in a trading firm right now looking at two totally different monitors.
Okay.
One of them is cheering, high-fiving their neighbor, maybe popping a little champagne. The other person is just staring into the abyss, absolutely terrified.
Watching their career evaporate.
Exactly.
Yeah.
And that is literally the market dynamic today. It depends entirely on which side of this great rotation you're standing on.
It really does.
We are witnessing something that, historians might eventually write books about.
Mm-hmm.
But right now, on the ground, it feels less like history and more like a brawl.
A brawl between two different realities, yeah.
We have a massive stack of sources to get through today. We've
Yeah.
got live market data that just doesn't make any sense, government leaks about something called Project Vault, and some very, very alarming reports coming out of Swiss refineries.
Mm-hmm.
But the mission today is simple. We need to figure out why the paper price of things and the real price of things have, filed for divorce.
And it's a messy divorce, too. Custody of the assets is definitely up for grabs.
So let's set the scene with the live numbers, because this is where that split-screen reality just hits you.
Yeah.
If you're a traditional industrial investor, life is fantastic.
Oh, yeah.
The Dow Jones is sitting at 49,529.
Mm-hmm.
It's deep green. Money is just flooding into what you'd call industrial safety.
Factories, infrastructure, the boring stuff.
Tangible assets, things you
Yeah.
can actually kick.
Exact.
But then you look over at the NASDAQ 100.
Yeah.
And it is a bloodbath. Down nearly 2%, sitting at 25,014. If you are in tech, if you're holding those, AI darlings from 3 years ago,
Yeah.
you are getting liquidated.
And that specific divergence, that's the critical signal here. Usually when the market tanks, everything tanks together.
Right, correlations go to run.
Exactly. Liquidity dries up, everyone sells everything to get cash. This is different. This is a violent rotation. It's capital fleeing speculative promises.
Like software margins.
And future growth and running for its life toward things that actually exist in the physical world.
And the fear gauge, the VIX, it backs that up. It's spiking up to 18.74. But the number that actually scares me, and I know the bond guys are sweating through their suits right now, is the U.S. 30-year yield. It's at 4.914%.
That is the danger zone.
We are whiskers away from that 5% red line. Why is that number, 5%, such a psychological trigger? Why does the world end at 5%?
Well, because the entire financial architecture of the last, 20 years, it was all built on cheap money.
Right.
At 5%, the math just stops working for the U.S. government's debt service. It becomes way too expensive to just pay the interest, and it stops working for all those leveraged tech companies who need cheap loans to grow.
So at 5%, money becomes too expensive to fake it anyway.
Things start breaking.
And while stocks and bonds are having this identity crisis, we have the stars of today's deep dive, the metals. Silver is at $86.39. Gold is knocking on the door of $5,000.
Huge numbers.
Huge. But here's the weird part, and this is the paradox we have to figure out. Just a little while ago, it looked like these metals were crashing.
It looked like the floor completely fell out.
Right. Silver dropped 30%, gold dropped 11%. If you were holding it, you felt sick. You were questioning everything. And now, snap, we're back at record highs.
Yeah.
So before we get to the government secrets, help us understand that crash. How does an asset drop 20% and then immediately rocket back up?
Was the crash fake?
Yeah, was it fake?
In a structural way, yes.
Yeah.
It was what we call a stop-loss cascade. And this is really important to understand because it tells you who or, what is actually moving the price. It wasn't fundamental.
It wasn't because people suddenly hated gold.
No, not at all. It wasn't because people decided gold was just useless rocks.
So what was the trigger?
The announcement of Kevin Warsh as the next Fed chair, the market algorithm, it tags him as hawkish.
Meaning he likes higher interest rates, tighter money, all to fight inflation.
Right. Which, traditionally, is the kryptonite for gold. Gold doesn't pay interest, so if rates go up, the textbook trade is you sell gold and buy bonds.
Okay, that's the textbook trade.
But here's the mechanism. It wasn't humans making that nuanced decision. It was algorithms. The news headline hits the terminal. Warsh appointed. The algos instantly trigger a sell order.
And that initial sell pushes the price down.
Let's say 2%, standard volatility.
Okay.
But down at that minus 2% level, you have a whole bunch of leveraged traders. These are people who borrowed heavily to bet on gold.
Right.
And because they're playing with borrowed money, they have very strict stop-loss orders set up. They basically told their computers, if it drops 2%, sell everything immediately so I don't lose my shirt.
So the algo hits their tripwire.
Correct. And when their stop losses trigger, That dumps even more paper gold onto the market, which pushes the price down another 3%, which then hits the next level of stop
It's
losses.
a domino effect.
Yeah.
Or a snowball rolling downhill.
It's a liquidation event. It has
Oh.
nothing to do with value. It's
Mm.
what Michael Burry calls a liability mismatch. These
Mm.
traders had margin calls in US dollars. To get the dollars to pay their debts, they had to sell the asset, the gold and silver. They were forced sellers. They didn't want to sell. The math made them sell.
So the price on the screen, the paper price, crashes because computers are just frantically dumping contracts to cover debts.
Yeah.
But this is where the story gets wild. This is where the divorce happens. While the chart on the screen looked like a total disaster, what was happening to the actual physical metal bars?
They vanished. This is the physical reality check, and this is why today is so different from 2008 or 2020. While the paper price was plummeting, we have intelligence reports coming out of Switzerland, which is the global hub for refining, saying that major dealers have zero stock.
Zero. You mean like empty shelves?
Literally zero stock of silver and small gold bars. The moment inventory arrives, it is sold. It doesn't even hit the shelf.
Wow.
Dealers have actually moved to appointment only just to manage the panic buying. They can't have people lining up out the door for metal that isn't even there.
That's dystopian. So you have a screen telling you the price is crashing and a dealer on the phone telling you, sorry, I can't sell you any because it's all gone.
That is the bifurcated reality. The leveraged paper market is driven by margin mechanics, by algorithms. The physical market is driven by absolute scarcity. And right now, scarcity is winning.
Scarcity is winning. And I think the government has finally realized that this isn't just a market quirk. It's a national security issue. Which brings us to the big news. Project Vault.
This is huge, and it hasn't really hit the mainstream news cycle yet.
It sounds like something out of a spy movie, but this is official. The U.S. government is stepping in.
It's a confirmed $12 billion strategic reserve, and it's managed under the Export-Import Bank. Now, usually when we talk about stockpiles, we think of the military.
Right, the Strategic Petroleum Reserve.
Or defense stockpiles for missiles and tanks, making sure we have enough titanium to build fighter jets if the supply chain gets cut. But Project Vault is different. This is the first stockpile explicitly designed to protect the civilian economy, commercial industry.
That is a significant shift in philosophy. They aren't worrying about the tanks. They're worried about keeping the lights on and the factories running.
Correct. And crucially, silver has been officially designated as a critical mineral for this project. That validates the entire thesis that silver is no longer just a monetary metal or jewelry.
It's a national security asset.
For electronics, solar panels, medical devices, tech, you cannot have a modern economy without silver.
But it's not just about buying the metal, right?
Yeah.
There's a policy component here that feels, well, it feels a little controversial. There was that proposal from Vice President J.D. Vance about a price floor.
Yeah, walk us through that.
It's called a preferential trade zone for critical minerals among allies. The idea is the U.S. will set what they call reference prices for mining, refining, and processing.
A reference price? That sounds a lot like a minimum price.
Essentially, yes. It acts as a floor.
Okay, let me play devil's advocate. I'm a free market guy. Isn't that just price fixing? Isn't that the government interfering with the free market?
It is interference, absolutely. But you have to look at the motivation. The fear isn't market forces. The fear is predatory dumping.
Meaning China.
Implicitly, yes.
Yeah.
The administration knows China controls a huge percentage of the global supply chain. If China wanted to kill the nascent U.S. mining industry, they could flood the market with cheap supply, crash the global price for 2 years, and bankrupt every new American mine.
Ah, I see. It's the Walmart strategy. Lower prices until the local competition dies, and then you own the whole market.
Exactly. So under this plan, if the global market price drops below this reference price, then adjustable tariffs automatically kick in.
So if you try to dump cheap minerals into the U.S. to kill our industry, the tariff just brings the price right back up to that reference level.
And that changes the entire game for mining companies.
It completely de-risks the timeline. I mean, think about it. It takes about 29 years to develop a mine in the U.S. from discovery to production. It's a nightmare of permitting and capital.
And no investor wants to fund a 29-year project if they think the price might crash in year 10.
Right. Why build a mine if silver could drop to $15 and you lose everything? But if the government guarantees a floor price, If they say, no matter what happens globally, you can sell it here for X.
Suddenly, that capital starts flowing.
It's building a moat around physical assets.
And looking at the data, they are building that moat just in time because the supply chain looks like it's snapping.
It's beyond snapping. In some places, it's already broken. We mentioned Switzerland being out of stock, but the specifics are really telling. Gold coins, gone. 100-gram bars, gone.
So what's left?
The only things left are the big industrial bars, the 250-gram plus sizes. The retail stuff, the stuff regular people buy, has been wiped clean.
And this stress is showing up in the big exchanges too, right? The COMEX in New York.
Yeah.
We always hear about COMEX, but what's happening there right now?
The COMEX is flashing bright red. We're looking at the March 2026 contract. And right now, the open interest, which is the number of paper contracts promising to deliver metal, is multiples higher than the registered inventory, which is the actual metal sitting in the vaults ready to be delivered.
So it's like a game of musical chairs where there's one chair and 50 people.
That is the perfect analogy. In January 2026, just last month, the calls for delivery were 3.5 times higher than the previous year. People aren't just trading the paper for profit anymore.
They're standing for delivery. They want the metal.
They want the physical. And if that trend holds for March, if people stand for delivery instead of just rolling over the contract, the exchange might physically lack the metal to fulfill those contracts.
That is a default event.
That's a default.
Usually, though, if there's a shortage in one place, the market fixes it. Arbitrage. Right. You buy where it's cheap, sell where it's expensive.
You ship it in from London or Shanghai.
But I'm reading here that mechanisms are broken, too.
It's the Shanghai anomaly. This is the smoking gun. Right now, silver in Shanghai is trading at a massive premium over New York. At the peak, it was a $21 spread. Currently, it's around $9.
Wait, hold on. A $9 spread. So you're telling me I could buy an ounce of silver in New York for, say, $86 and instantly sell it in Shanghai for $95?
That's free money. That is the definition of arbitrage.
So why isn't every trader in New York buying silver here and shipping it to China to pocket the difference?
That is the trillion-dollar question. The fact that the spread exists and persists implies one of two things. Either there's a total logistical failure and ships just aren't moving.
Which we know isn't true. FedEx is still running.
Right. Or New York simply has no metal to ship. You can't arbitrage a phantom bar. You can't put a paper contract on a plane to China.
So if the arbitrage window is broken, it means the physical flow of metal has stopped. That is terrifying if you're holding a paper contract in New York.
It implies the New York price is not real. It implies the New York price is a phantom price for metal that isn't actually there.
Which brings us right back to that liability mismatch concept we started with. We saw with the metals flash crash, too much debt, not enough cash. But there's another warning flashing on the dashboard, and it's coming from Michael Burry. He's looking at Bitcoin.
Yes, and Burry is warning about a liquidity cascade in crypto that mirrors exactly what we just discussed in gold. It's the same mechanics. You have entities holding volatile assets, Bitcoin, against fixed U.S. dollar liabilities.
So they owe debt in dollars, but their savings are in Bitcoin.
Right, and if the price of Bitcoin drops, they face that dash for cash. They have to sell the Bitcoin to pay the debt, which crashes the price further. He points out some critical levels. He says under $70,000, MicroStrategy, the biggest corporate holder of Bitcoin, faces potential capital market closure.
And under $60,000.
Under $60,000, it becomes an existential crisis for leveraged holders. And we're already seeing smoke. Metropolitan Capital Bank closed on January 30th, and investigators are looking into links to crypto collateral failures.
It just feels like everything is tightening at once.
Yeah.
You've got the metals squeeze, the crypto leverage risk, and then there's the elephant in the room, the biggest borrower of them all.
The U.S. government.
Yeah.
The macro backdrop is the fuel for this entire fire.
Yeah.
The U.S. Treasury has to roll over $9 trillion in debt in 2026 alone.
$9 trillion. That number is just... It's hard to even process. That's bigger than the GDP of almost every country on Earth.
It's massive. And they have to find buyers for that debt at a time when faith in the dollar is wobbling. I mean, look at the trade deficit. It exploded by 94.6% in November.
Which means the U.S. needs a weaker dollar to survive.
They need a weaker dollar to export their way out of this trouble. But a weaker dollar makes imports more expensive, which drives inflation.
Which drives people into gold and silver. It's a feedback loop.
It's a total feedback loop. You debase the currency to pay the debt, which scares people into hard assets, which makes the currency look even weaker. And then you throw the energy shocks on top. Freezing weather in the U.S. cut crude output by almost 500,000 barrels a day.
plus all the geopolitical tension with Iran.
Right, talks are happening in Oman, but the U.S. has naval assets parked right nearby, threatening bad things if those talks fail. It's a powder keg.
And let's not forget the EU raiding U.S. tech firms.
The tech detox, they're calling it. It's just accelerating that rotation we talked about at the beginning. If Europe is cracking down on U.S. tech sovereignty, investors are even more motivated to dump the NASDAQ and buy real assets.
So let's zoom out. We have a world where paper assets are risky, tech is being liquidated, the government is trying to floor commodity prices because they're terrified of running out, and physical metal is vanishing from vaults. For you, the listener, trying to navigate this, is there any good news?
Where's the opportunity?
Yeah, because right now, I just feel like buying a farm and hiding.
Well, amid all this chaos, there's a fascinating aha moment forming in the mining sector, and it comes down to a simple market inefficiency called a reporting lag.
Okay, explain that. How does a lag help me?
Okay, so gold and silver miners recently reported their Q3 2025 earnings, but think back to what prices were then.
Much lower, before the spike, before the panic.
Exactly. So the earnings looked, okay, but not spectacular. They reflected $25 silver or $3,000 gold. But now we're in Q1 2026. Prices are near $5,000 for gold and $86 for silver.
So the miners are currently digging metal out of the ground that's worth vastly more than what's on their last financial statement.
Right. So the Q4 2025 and Q1 2026 reports are going to be monsters.
Monsters.
They're going to reflect this new, much higher average price. But here's the kicker. Wall Street analysts, they work on models, they're slow. As these new reports come out, they will be forced to upgrade their price targets.
And who reads those price targets?
The algorithms. When the targets go up, the algos trigger a buying spree. We're likely sitting right in front of a massive re-rating of the entire mining sector because the data hasn't caught up to reality yet.
That's a classic inefficiency. The reality on the ground or, in the ground has changed, but the paperwork just hasn't caught up.
And that is usually where the biggest opportunities are found.
Yeah.
In that gap between reality and the report.
So let's bring this all together. What does this all mean for you? We were seeing a great rotation.
Yeah.
Money is fleeing the promises of tech and paper markets and running for the safety of physical things.
Industrial stocks, gold, silver.
And the government is validating that shift. By putting a floor under commodity prices with Project Vault, they're essentially telling you that real things matter more than financial engineering right now.
They're betting on the physical world.
And the shortages, the empty vaults in Switzerland, the broken arbitrage with China, they're exposing just how fragile that paper market really is.
It really challenges the fundamental assumption of modern investing, liquidity. We assume we can always click sell and get cash.
We'll click buy and get goods.
Right. But this market is showing us that liquidity is a privilege, not a guarantee. When everyone rushes for the door at the same time, the door might be locked.
It's a heavy realization. We spend so much time looking at the price of a contract on a screen. We assume that contract is the asset. But this deep dive really drives home the difference.
It does. A promise to pay gold is not gold. A Bitcoin ETF is not Bitcoin. A share of stock is not the factory.
So I want to leave you with this thought to mull over. The entire global financial system runs on confidence. The belief that a piece of paper or a digital entry represents something real. If the paper market relies on the assumption that you can always trade your contract for physical metal, what happens to the price of that contract when the world realizes there isn't enough metal to go around?
That is the multi-trillion-dollar question.
Thanks for listening to The Deep Dive. Keep your eyes on the physical, not just the digital. We'll catch you next time.